Everything's connected to everything else as far as I can tell, but let's start with the Federal Reserve decision on Wednesday, raising 25 basis points, not exactly saying what comes next, but at least opening the door to pausing. Is it justified, the idea of a possible pause, given where we are with the economy in the United States?
Well, of course, we've ended the week with a really strong employment report. You know, we've had 10 interest rate increases in a row, but now 13 payrolls numbers that exceeded expectations. And, you know, David, economists we expect them to be wrong, but they're not usually wrong in the same direction every month for over a year. So that does tell you something about the underlying strength of this economy and certainly of the labour market, which has continued to confound the Fed and made its job quite difficult in trying to balance that tightening, that historic degree of tightening in the last year, against the sort of justified fears of a creeping credit crunch, problems for regional banks, and, you know, still inflation above target.
Well, let's talk about inflation just for a moment, the connection between the strong labor market. And by the way, including those jobs numbers were some pretty robust wage gains month over month. So as a practical matter, have we really got our arms around inflation? Do we have any reason to believe that the monetary policy of the Federal Reserve thus far is having a material effect? It's having some effect, a material effect on inflation.
Well, I think it is one of those things that has the policymakers in the Fed wondering, you know, has the transmission mechanism that takes these rate increases out to the broader economy, has that broken down? Has it become slower than in the past? Or is there something specific in the sort of post-COVID US labour market that's causing a delay but not an end to that transmission of tighter policies? I think what has changed is you have in these problems in the regional banking system, which I know we'll probably talk about, you know, the failure of yet another bank, that is telling you that there's something that is very tangible that is going to quite shortly has to have an impact on hiring, and that's the squeeze in small business lending. You know, you mentioned my podcast, Stephanomics, and we heard in this week's episode actually about somebody who wants to invest in a pickleball/restaurant having trouble getting a loan, a small business having trouble getting a loan. Now, you know, pickleball is a massive phenomenon at the moment. If you can't get money for that, I think we know that lending conditions are tightening, and that is, if small businesses are the ones most affected by that kind of lending squeezing out, tightening up, drying up, and it's small businesses that are the source of most job growth. So it may not happen this month, it may not happen next month, but we do now know that this labour market is going to cool, and we have to assume that's going to bring down inflation, might also cause a recession.
Well, let's talk about recession specifically. I want to come back to the regional bank issue in a moment, but the economists have been predicting recession, the likelihood of recession, for some time now. Do the jobs numbers help put a lie to that? Is there any prospect on the horizon right now of recession, given what we're seeing in the strength of the labor market?
Look, I think those who have all along considered it to be impossible to have that soft landing that the Fed is certainly hoping for, are not budging, even in the face of these numbers, because for starters, you've got a little bit of weakening below those headlines. So you've got revisions in previous months to the payroll figures. The household survey is a little bit weaker than it's been, but also, as I just mentioned, this creeping credit crunch that's happening, and it's going to primarily affect small businesses, those that can't raise debt in the markets that are reliant on banks. You know, I think there we see quite a good reason to expect, if not a recession, then something very close to it. All of our monitoring, the recession probability monitor, you know, maybe take it with a pinch of salt, but we think it's still more likely than not that we'll be in recession in the second half of the year.
Stefano, let's go to the question of the regional banks and the pressure we've seen. We had the Silicon Valley Bank, and then you had Signature Bank, and every time when we come up, we say, oh, it's really idiosyncratic. It was some special failure of the management there. And then we had First Republic. Well, that's a different sort of idiosyncrasy. This week, we saw PacWest, we saw Western Alliance. It seems like every time we look around, there's another idiosyncrasy popping up. At what point does it become systemic rather than idiosyncratic?
Yeah, and I think we're starting to say idiosyncratic is if you're a bank that's not one of the big four banks in the US at the moment. That's starting to feel like the divide, because almost every other bank at one point or another has been under pressure, and almost every other bank in the US may not be in the kind of difficulties that we saw, the kind of extreme business model, extreme disregard of risk that we saw in some of those other cases, but is certainly facing a kind of fundamental issue inverted yield curve makes it very severely inverted yield curve in the key part of the market between 3 months and 10. That making it hard to make money, and this long riding kind of expectation that you can make profits by not passing on short-term policy rates at a time when short-term policy rates are rising. Well, that's harder and harder in a world where we know we can have these digital, instantaneous, massive falls in deposits and bank runs. I think there are questions about quite a lot of banks in the US right now. Not that they're going to survive, but certainly that it's going to be quite hard for them to make money in the near future.
Except for the very big ones, as you suggest. They seem to be doing very well, thank you, ma'am. Does the Federal Reserve face a form of a zero-sum game here, where either it goes after inflation with increasing rates, or it helps the banks by not increasing rates or even cutting rates? Because part of the problem here, obviously, is an interest rate risk issue that was created, maybe intentionally, maybe it's a good thing, by the rapid increase in the rates.
Well, that's how the policy is supposed to work. In many ways, at least it's not aimed at reducing the bank's ability to make money or challenging its business model, but it's certainly aimed at tightening credit conditions, reducing lending, and reducing economic activity as a result of that. I think we've got to a point, though, where the Fed and indeed other central banks are so keen to persuade us that they're not going soft on inflation as a result in response to these concerns around the banks, that there's almost a risk of going the other way. You could see that with Jay Powell this week. There was absolute determination of that separation principle that we are going to continue in our battle against inflation, and we have other tools. We're thinking in a separate way about the banks, but they obviously can't be completely separated.
So everything you've just discussed would be plenty, but on top of that, we had Janet Yellen, the Treasury Secretary, this week saying, by the way, that so-called X date, when the government will really run out of money and not be able to pay its debt, maybe as early as June 1. We have meetings coming up next week of the president with leadership in Congress. Give us a sense of how the debt ceiling crisis may play across the issues we've been discussing.
Well, when we talk about the US economy dodging recession, so we're basically saying that it's going to shrug off the effect of the credit crunch in the smaller lenders that I was talking about earlier, but also that we won't have some default moment or a big increase in financial tension around fears of a default in the next month or two. And we think, if that actually came to a head, that could have a very significant effect on the economy, because, if you think about it, it means suddenly, overnight, the federal government has to balance its books, and that means very significant reductions in spending there and then. Now, we don't think it will come to that. But the kind of tensions around that, I think, do give Janet Yellen and the broader banking community. I was at the Milken Institute earlier this week in LA, quite a lot of concern under the surface about how this debt ceiling issue is going to play out. And some phone calls being made to Congress, but no real sense that people are getting a handle on it.
And finally, Stephanie, let's not leave Europe out of it. We heard also from the European Central Bank this week, who hiked as well 25 basis points like the Fed, but unlike the Fed, said, you know what, we're going to keep going. Madame Lagarde was, I thought, very clear about that. What's the difference between the two economies, and can the ECB take such a different route from the Fed if the Fed, in fact, does pause?
Well, of course, the European Central Bank started later. It's in a very different kind of situation. I think we tend to maybe, certainly if you talk to people in Frankfurt, they say we overplay the amount to which they're watching every move of the Fed and thinking about their move in relation to that. But I think it is the case that interest rate rise from the Fed and the talk of possible pause from the Fed, did give some cover to Christine Lagarde and her colleagues at the European Central Bank to reduce the amount of increase that they had. So we just saw that quarter point. They're slowing the path of interest rate rises. She did talk about another 2. We think it's more likely to be another 1, that you will see a pause in the summer, because they're allowing their balance sheet to run off after June. So that's a continued form of tightening that they can rely on. But you're right that ultimately, if the market's right, for example, that the Fed's going to start cutting rates the end of this year, that could prove very difficult for the European Central Bank, because they're certainly a long way from cutting.
Is there a prospect in Europe of having similar difficulties with the banks to what we've seen in the United States, given the fact the ECB has been raising rates?
Well, Well, it's interesting. I mean, we haven't got quite the same dynamic playing out. You don't have the same inverted yield curve and that kind of pressure on profitability of the banks. But on the other hand, you have the fact that the broader economy is much more dependent on bank lending. So a smaller problem, a smaller squeeze on the European banking system could have actually as large or even a larger effect on the economy. So, it is something that the European Central Bank has to look at. We are seeing credit conditions sharpen, tighten dramatically in the last few months. I think that'll be another factor that will cause the European Central Bank to pause in the summer.